Okay, so welcome everyone. I am Tiffany Joseph, real estate professional and owner of Joseph Realty Group, and welcome to my web series titled From Renter to Homeowner, where throughout many webinars, I'm going to walk you through the home buying process, but breaking the information down in bits and pieces so you're not having to sit through like a 2 to 4 hour home buying course. So tonight, our first topic is really about that first step in the home buying process, which is the loan process, understanding your credit. And I actually have one of my trusted business partners, Miss Lisa Rochester with PRMG Mortgage Company. And she is going here joining us tonight to help talk about this topic. She's an expert. She's been doing this for a long time. So Lisa, I would like to welcome you to my web series.
Hello. Um, Hi, guys. My name is Lisa Rochester. I'm with PRMG, which is Paramount Residential Mortgage. We're a local lender here. And so we specialize in FHA, VA, conventional, and a little bit of jumbo and foreign national loans as well. We cater to a lot of first-time home buyers. I've been in the business for like 20 years, so I'm used to first-time home buyer, they're nervous and they want to know what this whole process entail. And so sometimes we're a little bit nervous because you are not with the right broker who's going to hold your hands and walk you through this time. So I have always dealt with my first-time home buyers because I know it's a step, and it's a great step to move away from rental. So you want to take that step because at least you have equity growing. You have so much benefits buying a home versus renting. I don't want to take too much of Tiffany's time until she's ready to answer.
No, Lisa, and this is what I love about you is that I have a passion for this same topic, is that really helping people understand how they can own something and stop renting. And again, I have rental properties, so it hurts me when I have people coming and saying, hey, I want to rent from you, and my rental's going for like $1,800 a month. And I'm like, your credit score is over a 600 and you can afford 1,800. That my first question to them is, have you considered purchasing a home? And what I get is, well, yes, but I don't know. I don't think my credit, and there's just so many things. And I just find that people don't understand. And that's really the biggest challenge. And what I love about you is that whenever we've worked together, you have that same passion and really walking them through the process and helping them understand. So what I'm going to do is jump
Mhm.
into, because what I really want people to get out of this at the end is, one, if you are someone who's currently renting and you are even considering purchasing a home, I want you to understand the process from a loan standpoint. That's the whole point of this webinar. If you are a current homeowner and you have maybe owned your home for a few years, there's still information here, because Lisa can also, the many things she's going to walk you through could also help you from a refinancing standpoint. Lisa will explain how interest rates are low and you could actually lower your monthly payment by also refinancing. So Lisa, my first question to you is, what
Mhm.
are the important factors when someone needs to apply for a home loan?
Okay, so first we want to look at, how have you paid? Because one of the thing when you're going to buy a house, you want to make sure that you're going to be able to afford the property. So I always want to look at the credit. I want to see the overall history of how you've maintained payments. That's a very important factor because buying a home is not like buying a car. It's not going to go away in 5 years, okay, unless you sell it, but it's going to be a 30 years. So it's a responsibility that you have to make sure that based on income, it's going to be a comfortable payment for you to do. So I always want to find out from my clients, what exactly is your comfort zone for a monthly payment when you're going to buy a house? It's not what you qualify for, it's actually what you can afford. Because a lot of times they don't disclose some of the debts that they do pay, and some mortgage brokers do not take that in consideration. But that's very important because I want to make sure that they can maintain that property. We look at credit. So credit starts from like a 550 score, but it requires more down payment when the credit score is under 620. So it's a more delicate situation. So I always want to have my clients, like if I see somebody, they're borderline at 580, Rates are going to be higher for them. So I want to give them incentives. Hey, maybe you need to do this to the credit card, or maybe you need to do this in order to get the score up. Because an ideal score is like 620. You're more in a ballpark where you sign a contract and God forbid something happened to the score and it dropped, you don't have a loan when you're at 580. You know, you're too close to not getting that loan. So you want to make sure that you maintain that 620 at least, so that it's more attractive rate wise, because you're going to get a better rate. You're going to get, less points to be paid. Sellers look at, they look at, the fact that the borrower has a 620 score. They're more likely to take the contract than you looking at a borrower that has 580. Not that they can't qualify, not that there's no loans out there. There is, but because of the interest rate where you're going to pay over time, because it's going to cost you because of that rate, of that score where you are. It's going to cost you over time, because if somebody's at 620 and I can give them a 3% without paying anything, no points up front or anything, then I'm in a better position if I can get to 620 versus I'm at 580, but I'm charging you 4 points or 3 points to get that rate. So in the long term, you're going to pay a cost to get that same loan that you would have gotten had you just paid one or two credit cards and boost the score up. You'd be in a better position. So my thing is a long-term thing. Some people might just want to get them into a house. I'm not that person. I want to see the best of my clients, and if I can show them a better route, I will. So there's credit, which is a big factor, right? And there's also income. So we look at what you owe on credit. Okay, so we don't count like your rent or your light or your water. Those are utility bills. But what we count is your liability. So when I pull the credit, I want to see what you pay, your car payment, your student loans, your credit cards, and all those we tally up into what is called, we do a percentage of that, which is called the debt to income ratio. So we want to look at, okay, what is your income? And we use, a percentage of that in order to qualify you for a loan. Then we want to make sure that you have the money in the bank. So it can be a gift based on score. We can work with gifts. So mom, dad, aunt, uncle, friend can give you a gift, depends on the program that we're choosing. So, you can accumulate, you can have, I had an old computer, or I had a chair, or had a sofa that I'm not using anymore, but I can sell it. That's also source of funds for us, because it was yours and you're selling it, and it becomes the source of funds. So there's a lot of little things that we can do as a lender that can help the borrower to actually get into a property. And at the end of the day, buying your home is going to be far better than you renting. Because at the end of the day, like even a pandemic like last year, you take, for example, somebody who was renting. The landlord says, you can't pay me and you have to leave. Last year, people who had a mortgage could call their mortgage company, and they could actually work something out for them. If they've lost their job, if there's less income, one of them got sick, or whatever it is, but at least you have that cushion. So when first time home buyer don't understand that buying a home actually puts you in a better position if you ever lose your job, or if you ever, decrease on your income, you have more of an option with a lender than you do with a landlord. There's
Yeah.
more leeway.
Lisa, I
Mhm.
want to back up a little bit.
Mhm.
There was a question that came through the
Okay.
chat, but if I had to recap the credit piece, right?
Mhm.
580 is about the minimum score you could probably have to start the process to see if you're pre-approved. But that is going to give you a higher interest rate, right?
Correct.
If you compared someone who has a 580 versus someone who came to you with a 620, same income level, same debt ratio, the person with this credit score of 620 would probably get the 3% interest rate. The person with the 580 would probably get 4% or maybe higher, correct?
Or maybe they will be at the same rate, but it's going to cost them more for that rate.
Okay.
So
Now,
there's what is called discount points that they have to pay because of where that score is.
so can you explain that? That's what one of the questions came up, is what are points? So if you could explain points a little easier, because that is a confusing topic on points.
Okay, so credit scores in order to get a credit score, there's factors that they look at. So they look at how much money you're willing to put down, right? So the LTV, which is loan to value, which is your sale price versus what you're putting down becomes the loan to value, right? So that's the factor that they look at when we're doing a rate. Then we look at the score. We also look at the loan amount and we look at what your debt to income is. So those are factors. One of the things is because the score is under 620, you're now at a tier system, which means it's going to cost you money out of your pocket. Points means that you're going to have to pay in order to get that rate, or you choose a much higher rate that doesn't have a point, doesn't have any charges. So it means if your closing cost was $10,000 on a normal case, it's going to be more because of this rate and where your score is.
So really what you're saying is to, and the person who asked the question, if you want to type back into the chat about if you want a follow-up question, but if I had to summarize, is that a credit score between 580 and 620 is not that big of a difference.
No.
So if you are in that 580, I think you could look at paying off your debt so that you could build it up to a 620. Because what Lisa is saying is that if you did try to apply for a loan with a 580, you're still going to be required to put some extra money out of your pocket that if you had the 620 you wouldn't, and that extra money would be to get your interest rate a little bit lower, and it would come in the form of you paying more within your closing costs. Would that be safe to say?
Right. I mean, I'm not saying that the program is not there, because if somebody is at 580 or 510 and they have 10% and you can do the 510 all day long, the loan is available. It's just from a financial standpoint, my suggestion, not that I can force you to do it, but my suggestion would be to actually work on the score and get you over that rump, that you're not having to shed out extra money that you really didn't need to. Had I just, okay, I owe $1,000 on my Chase card and my limit is $1,000. But I said to you, listen, if you spend $500 on that card, it's gonna increase your score. So there's options that I could suggest to you that will actually save you over time.
Yes.
It's some people it's a quick fix, but it's not a quick fix. It's over time that you see that benefit. Mhm.
I'm just reading the comments that are coming through to
They're
try
a
to
little
address that
confused.
by a higher interest rate. So she's still wanting a little bit more
The card it
clarity
would
because
be costlier by a higher by okay, so the higher the interest rate is at a 580, more than likely you're not gonna have that cost. So if you choose, okay, so say the market at prime is 3%. And I go in and I look at a 620 score and I can lock him at 3%. But I look at a 580 score and at 3%, there's a cost for it. Now, I could say, okay, there's no cost at 3.5. So you can make that choice if you want to do a 3.5. Now, the payment is going to be higher than you would at 3. So that's a choice that you would do. Then I would say, okay, I can live with a higher cost, higher monthly payment each month because I don't have to come out of pocket with extra money. I
yes.
know that I won't get it, but I can live with the extra monthly payment that I'm paying over time. So the loan will work. It just would it if you have to ask yourself, is this a better fit for me? Then I do a little repairs on my credit and make it even easier for me.
So let me just summarize again. If you have a credit score around a 580, right? Or really
Hmm.
lower than a 620, between a
Hmm.
580 and under a 620, there are
Hmm.
two options. Option one is you can buy down your interest rate,
Correct.
correct? And
Well, you're
that,
not really buying it down. You're not really buying down the interest rate. What happened is because where the score is, there are adjustments for that score. So at 580, you're gonna have an adjustment alone for like 3 points. So because of that, that money has to come from somewhere because there's an adjustment because of the score. Now, if you take away the 580, now you go at 620, that adjustment goes away.
correct.
So because of where the score is, there are adjustments and adjustments channel to money. That's what it really means.
Okay. And let's say that's at the lower interest, but if they took the higher interest,
Mhm.
if they
Hello?
took the
Mhm.
higher interest, then they could just pay that extra through their monthly payment. They won't
Correct.
come up front, but their interest rate would be better. I
Higher.
think visual would help me understand better. Okay. So for, I think I will say the discount question is a little confusing, and what we
Okay.
can do is have a separate follow-up. If we get a lot more questions, maybe we could meet again and do this over that, because it is. But really, where the gist of where we're getting at is the minimum credit score is about a 580. 620 is ideal. So credit is the first step. Then
Mhm.
you were talking about income, right? So
Right.
income really is not just, let's just say someone made $50,000,
Mhm.
but they had no debt, but someone made $50,000 and they had $60,000 in debt. That is where the most important thing is, the debt piece of that. Is that correct?
Right. So you can have two individual, one makes 50, just as you said, no had no debts, right? But they make $50,000 a year. So that income is $4,166. So out of that, they can actually qualify for a mortgage payment of like $1,800 a month off the bat because they don't have no debts. So that will equal to like a sale price for like 250 to 260 property, but that's like $50,000. That's just us doing calculation off the bat. Now you can have somebody that has $50,000, but in income, but they have student loans. So student loans are a little bit different on each program that we do. Somebody like now, they have the coronavirus where they've now put most of the student loans in deferment. And a lot of people are using the deferment, which means they pay no money. We don't take those deferment. We need them to actually either be tell us what the total payment is would be after deferment, or if they're on an income repayment plan, they give us the documentation showing that this income repayment plan, I'm allowed after this deferment is finished, I'm going to pay zero. I still can take that zero on a conventional loan. Now, if somebody is going on FHA loan, which means at a 580, you are only subject to a FHA loan because that's the loan that would be offered to you. You wouldn't be able to use those income repayment plans. So that kind of puts you in a corner as well because I can only go FHA, you know? Or if you're a veteran, then you could go on a VA loan. But you now put yourself in a corner because that's the only option that's available. So with student loans, I have to look at each individual separate and suggest what's the best, and then they could choose. I give them options, you know. If it's a large amount and it's going to be a high monthly payment, then they might not have a choice to go to FHA. They might have to switch to conventional because that's the only one that's going to allow them to have a small monthly payment. And then, of course, we put credit and we look at all other debts. So we will look at the car payment that they have, the credit cards. I don't care what the balance is, as long as all we care about is the monthly payments. So if you have $100,000 car and your payment is $500, that's all we care about. So we look at all those things, those factors, and we look at the income that you make, and we do a percentage of that in order to qualify for the property. And then, of course, we have to look at your assets, which is your funds. So funds can be on an FHA, 100% can be gift. If the score is over 650, then you can do 100% gift. Um, I've seen where the system has done 620, but we want to make sure because DU can be sensitive, which is AUS, which is DU finding that you guys ask on, because we do what is called a desktop underwriting. So it's not just my personal thing that I'm going to do and say, based on this, I do a manual. No, we run it through a system that's called desktop underwriting. And from there, DU, Freddie Mac, the AUS system will give us a finding that will say approved eligible, referred ineligible, depends on the factors that is plugged in. So borrowers want to make sure that they have enough money So say, for example, on a property for, let's do a property for 250, the average amount that you need on an FHA is like $18,000. So you need 3.5% down on an FHA loan, and you need a minimum of about 4.5% of the total sale price as your closing costs. So you always want to have that. Now, if you're going on FHA and you have the right score, you can do 100% gift. If you're doing conventional, you could do 100% gift. So mommy, daddy has money and they say, oh, my daughter's going to buy, they can give you a gift and it'll be fine. You can save up the money. You know, we only need 1 month bank statement for FHA. So they actually can have all of their paycheck this month, and then next month they can buy the house because they're going to have the money by, you know, accumulating their paycheck, selling whatever they don't need at home, and use that funds to channel as source, because they can source it. There's the source is there, so we can use those funds.
So Lisa, back up for a minute. One of the attendees said this, what you just shared is a lot clearer. So I'm happy that was clear. You were explaining, because I want to spend a little time on the down payment and closing costs, right? Because people, I think, also feel a little bit overwhelmed. And so I'm going to ask you to restate those two things again, what you're estimating, what someone would need for their down payment and closing costs. And again, what she is stating is if you are not if you're not getting any first time home buyer program, right? Because people, they will help offset that. But if you are just outright saying, hey, I'm going to purchase a home exclusive of any type of program that offers any type of money, can you explain that part again for an FHA?
Okay. So FHA minimum down payment is going to be 3.5%. So you need to have 3.5% into this. It can be a gift as well as it can be on your own funds. Now, the remaining funds you need to close because you have closing costs. So you have the government needs their money because now you're buying a house. So you need to pay the government, the recording tangible tax and doc stamps. You also need to have a title company involved, which is going to do a title insurance policy and all other title work. So you also have to pay them. So there's costs. So those are the costs that's incurred in purchasing a property. Now, if you are getting a seller that is willing to give closing costs, right?
So not to cut you off, Lisa, before you jump to that, let's just back up, right? So I'm going to use an estimate of a home for $250,000. I'm using my own calculator here. So you're thinking, hey, you've told this person based on their income and everything, their debt to income ratio, that they could qualify to purchase a home for $250,000, right? Their down payment, if they're going with an FHA loan, which has the lowest down payment options, correct, would be 3.5%. So that's about $8,750. That is what that person needs to show that they have already sitting in their account. Is that correct?
But remember, they need the down payment and the closing costs. So they need to see both of them. So if they have the down payment and mommy's going to give them the closing costs, or the seller's going to pay the closing costs, then that could be verified.
Okay. So so your down payment off top, right? And so everyone understands is when you put in an offer, let's say you find a property for $250,000, you have to put the purchase price, the loan that you're going to receive is going to be less that 3.5%. So 250 minus 8,750 is how you would get to what that loan amount would be.
Correct.
Now, that's just what your loan amount is. What Lisa was talking about before when she talked about government taxes and all of those closing costs is separate. So Lisa, you were saying, if I'm correct, that for closing costs, it's about 4.5% of the purchase price or the loan amount?
Purchase price.
Purchase price. So that 4.5% times $250,000 is $11,250. So when I add 8,750 plus 11,250, that gives you $20,000. So as a rough estimate, $20,000, whether you're looking to get a gift from someone, whether you're looking at a first time home buyer program, whether you're looking to see if the seller will cover some of your closing costs, you need to estimate that. You need to figure out how you can come up with $20,000,
Right.
right?
Now, some
Okay.
property, as you see, some property taxes are very low. So that would take the closing costs down. So the range can be from 3.5 to 4.5, depends on the property, depends on the, the HOA, depends on the insurance that's going to be on this property, and depends on the taxes, all those things.
So I'm laughing because someone said I need to find someone who wants to give me those gifts. And that is true. So I think if I say 20,000, that probably throws people off. But there are ways that you can get that money, whether, as Lisa's saying, this is just a rough estimate because depending on where the property is located, it could be less to what she's saying. But it's to help you just understand what you are up against, right? So if we
Right.
recap, you need 580 to 620. 620 is the preferred credit score. What would you say the debt to income ratio would need to be?
Okay, so if the score is 620, then most times, I mean, I think 90% of the time, we're gonna get an approval at 56 DTI, which is the back end, right? So when we calculate, the mortgages are done in front end ratio and back end ratio. So front end is solely your income versus what you're purchasing is your front end, and it's really much less. So that will always be 45 or less. 45% of what you make is going to be your mortgage payment. It's not going to go over that. Now, the back now is going to be the mortgage payment and your debts, right? Versus the income. So then we know we can go up to 56 on an FHA loan. Conventional, we are going to 45, max 50. There's some people who will never go over 45 because of the credit score, and that they're not having all the income, they don't have assets. So maybe the system won't go over 45, but that's
Okay.
a conventional.
So
Now, VA
again,
can also go up, like
say that
veterans,
again.
right? So if you are a veteran, if you're a VA, right? You can get 100% loan. You don't have to come with any down payment at all. It's zero. Seller can give you the entire 6%, and you're into the house with no money, but you have to be a veteran.
So there's a lot of questions coming through. So I
Mhm,
just, before I answer, questions have come through the Q&A as well
mhm,
as in the chat. So just want to back up. So we discussed credit. You just explained debt to income ratio, that
mhm,
there's two ways that your debt to income ratio, that your ratio is calculated. You said front end, which is
mhm,
45% or less, and
mhm.
that is truly your income less
Versus what you're purchasing. So
versus
it's
what you're purchasing.
45% of your income. That's where your max monthly payment would be for a mortgage.
So let's use that $250,000 home price, right?
Hmm.
If you
Hmm.
want to purchase a home for 250 and I use 45, do I multiply that by 45%?
No, we're gonna use the income. So the income was 50,000, right?
Got it. Okay.
And income per month, because we're gonna use the monthly factor, which is 4,166. And then 45% of that is what you're gonna be for the monthly. That's what your maximum monthly payment can be.
Got it. Okay. So if we said someone made $50,000 a year monthly, that's 4166, times that by 45%, their maximum monthly payment, if and you could double check on your phone, was
Hmm.
about 1874.
Yes, yes,
Okay. So
yes.
1874 is still a lot, right? So think in
Mhm.
South Florida, I just said that someone is renting, paying $1,800 a month. That if you are making 50,000 a year, your mortgage payment, if you're looking at 1874 a month, that's a good, I'm sure you would be paying less. That's the maximum amount that you would be, but I'm sure you would find something paying significantly less than that. So that's the front end. You said the back end calculation is 56%, and that includes your mortgage, your debt, and your income.
Right. So we're going to use 56% of the income has to cover your debt and the mortgage payment.
Okay. Okay.
Yeah.
So we've discussed credit, debt to income ratio. We've discussed what your closing costs are. And just to reiterate on the closing costs, using an FHA loan, there are FHA loans, there are conventional loans. Those are the two common. There are other different types of programs, but the two commons are FHA and conventional. And FHA, and correct me, I would say, Lisa, is probably the easier one for people to qualify for.
Yeah, it's more lenient. Yes, it goes up to a higher DTI, and it also allows you to go in with less money and less score. So it's more lenient for you. But if somebody qualifies for both, that's the choice they want to take. You just give them that choice, because some people still likes FHA, even though they could qualify for a conventional.
Right. But someone who's around a 580 or a 620 is probably going to be more within an FHA loan.
Yes, the minimum for conventional is 620, and that's if the system allows you to get an approval. It doesn't have to get an approval at 620. And but so VA, people, the VA loan, if you are a veteran, you want to jump all over this, because there's so much good rates and options available for them, because you could go into a property with zero down, no money.
Yeah.
Practically, seller can pay most of your money for you. So you're like, and it's a guaranteed loan. Once you get that entitlement, you're good.
So the last piece that I want to jump to is just going back to, we talked credit, we talked debt to income ratio, we talked down payment. And I do believe that many people are probably like $20,000, like, I don't have that. That really makes them think that they would not qualify. So one of the ways that you can cover that 20,000, which consists of down payment and closing costs, is one, a gift, right? You said people get a gift from a family member, a portion. Now, when you're looking for a property and you're working most likely with a realtor, then you can negotiate and have the seller pay for some of your closing costs, right? So in a market when sellers are trying to, hey, get the property done, you can negotiate that with the seller as well, that the seller could cover that, a portion of your closing costs.
Or they have retirement, because remember, if you have a 401k, right, this is a hardship because you're going to be buying your house. They will allow you to pull money from your 401k because this is a purchase for your home. It's your primary home, so you can pull money from there. So that's an option that they could also take too. There's sometimes their retirement 203B might allow them to pull cash. So they have to speak to their, whoever they have as that has their pension plan, and find out what are the criteria. But a lot of times I've seen people, if they use the hardship end of it, where they show, I want to buy my house, they will allow them to do it. So they could try that route.
Yeah.
So that's a route too.
So sellers, retirement plans, gifts, and then of course, first-time home buyer programs. Those programs will help to cover that $20,000 amount. Now, I want to do a separate discussion on first-time home buyer programs, because they all just vary with requirements. Some, if you can correct me if I'm wrong, but you're restricted to a certain area within a city. They have income requirements that you have to meet. So there are ways that you can, the whole point that I want to get across to people is, don't be alarmed by the $20,000 number that we threw out. And again, this is based off of an estimate of $250,000, and we're just using some numbers so people can process the information, because there are ways that you can get that set up. But what I would say to someone is, if you are interested in purchasing, start to just put away a little bit of money, right? If you start, there's so many things that it show you how you could save $5,000 in a year or $1,000 in a year, and it's just by putting a little bit of money away. So
Correct.
Lisa, we have quite a bit of questions, and our
Hmm.
topic has been very popular. We are over our kind of 6:30 time. So what I want to do is just make sure I didn't miss anything just about the overall process. We talked credit, we
Hmm.
talked debt to income, we talked down payment and closing costs. The
Right.
last thing I think you could hit on is if someone wanted to get pre-approved,
Hmm.
explain pre-qualified and pre-approved, and just
Okay.
quickly run through initial documents that they're going to need. Once you do that, I think we can jump to everyone's questions. So if
Okay.
you have more questions, if you can, put them all in the chat area, and then we'll address them once she answers those two topics.
Okay. So, um, you also, so hold on. I lost my train of thought. So, when you come in for a pre-approval, right? So there's a difference between getting a pre-qualification and a pre-approval. A pre-qualification is somebody call in and say, I make $50,000 a year. My score is 800. Will I qualify for a mortgage? That's a verbal thing. So that doesn't go anywhere. If I write you a pre-approval and I give it to you, Tiffany, and I say, Tiffany, this person is good to go, this is not solid. You're not going to commit to a contract that will never go through because I have never seen the documents. I'm just hearing a verbal approval. Now, I don't like those because I don't want to put my name on something that first I'm going to jeopardize your money. I'm going to jeopardize Tiffany's time, my time. So I don't do that. So what we want to do is we want to get a pre-approval done, which means we need your W-2s, your pay stubs, your at least 1 month bank statement. I want to see your driver's license so I can make sure your name is spelled correct, your date of birth is correct, your address is correct. And we also want to see if you have a present mortgage. I want to see the debts that you pay. I don't need statements from like car payment and stuff like that because I'll see it on the credit what it is. So from there, we can look at the whole umbrella and actually give a pre-approval. Now, it's not cut in stone because things could happen. Like, job could get reduction in income, credit score could change. We could run a fraud guard and here comes something that was never told. You had a foreclosure in New York and I didn't know about it because it wasn't, or you had a piece of land in Puerto Rico and hey, it killed my ratios because I didn't know about it. So that's why you do a pre-approval, and a pre-approval means it's subject to change because if situation change, it's null and void. An underwriter has to now look at all the documents that you provided to make sure that they are real. And we pull from the IRS to make sure your taxes were really filed and there is income for real, because we have to make sure that these are legit documents. Not that the borrowers are stealing or anything, but that's just how loans work. We have to make sure that these are legal and legit documents. Now, there is a program like a lot of people who are on the DACA program. There is loans available for them. I just want to let them know also. So if you're here and you're on the Dreamers program, we just need the AD card. As long as it's not expired, we can take you into a loan.
Oh, that's really good to know.
Mhm.
We'll have to share out some information on that. So, Lisa, just really quick, we talked a lot about first time home buyers, but there are also people who own and
Mhm.
might be considering refinancing. Can you just quickly explain what would be, from all the information we just discussed, what would be any additional piece of information you need or any separate requirements?
Okay, so say somebody closed 2 years ago and their loan at the time was an FHA because that's what they could afford and that's the program that fit them at the time. Today, market has really increased and so values in the property. I would take that borrow and I would suggest to the borrower, look, you can actually flip this loan to a conventional. You can get rid of the mortgage insurance that you're paying, 200 and something dollars a month or whatever it is.
Hmm.
I could change that rate from a 4.5 or 5% because that probably was at the rate at the time. And I can flip you now to in the threes or maybe twos, depends on the score. And I can also no put you back into a 30-year. I can put you now into a 20, into a 15, but I'll show you the comfort zone. But at least you're going to save years of payment that you're now going to cut that term. So I give those options available to my clients when they're ready to refinance, because that's a good thing that they want to do.
Okay. Okay. So let's jump into some of the questions, and then we will close out. Because again, these are great, but I don't want to take up everyone's entire
Fine.
evening.
Okay.
So this question is, so is a conventional loan better choice if you have excellent credit and no debts?
Well, again, that program, I usually put the monthly payment to my clients. So if I show you the FHA and the monthly payment, most times, because if the score is excellent, so excellent scores to conventional means 740 and above. That's really their excellent score. Then they start rewarding you because, hey, you got good scores. So the mortgage insurance is going to be less, rates will be better. So then I'll show them the program and I'll say, okay, based on this, I think your payment is going to be better on a conventional than it is for FHA. But the ultimate choice is really up to the borrower. We can show them, but the consumer has to make their decision.
So, Lisa, let's explain, because we've talked about private mortgage insurance, and I don't think people will catch FHA conventional loan. They have two different requirements from a credit score perspective. They have different down payment requirements, but there is also talk about the insurance piece between the differences between the two.
So FHA doesn't matter what your down payment is. You're still going to pay PMI. You're not going to get rid of
private mortgage insurance for the life of the loan.
Correct. It does not go anywhere. You have to refinance that loan in order to get rid of it. You also have what is called upfront mortgage insurance, which is not, you don't pay monthly on it, but it's added to your loan amount. So when you see somebody putting $250,000 sale price and they put the 3.5% down, a lot of people wonder, why my loan amount a little bit higher? Because you're going to pay 1.7% on that loan on the upfront MI. But if you refinance that property and turn it into a conventional, if you haven't used, they will just take out what you've used already for that loan and give you a refund. So it comes back to you eventually, If it's a conventional loan, now there is what is called mortgage insurance, and that goes by your score, your zip code of the property, the loan amount, and your DTI, and they factor that as to what your mortgage insurance is going to be. Now, after your property reaches 20% equity, that mortgage insurance will go away. So there's two ways that mortgage insurance will go away. Sometimes the lender will do it automatic, and sometimes, again, you, the consumer, have to prove to the lender that there is properties in my area that is actually selling, and I do have 20% by doing an appraisal. And you could submit it to them so that they could see that there is comps in there that's going to match that 20% equity that you're telling them about. And that will get rid of your mortgage insurance, which will lower your payment.
Yeah. But someone starting out, again, FHA is what most people starting out, because it offers you the flexibility in getting a loan, which is okay. It's still, when your mortgage payment, when you're calculating someone's mortgage payment, and we calculated that 1874, that would be including that private mortgage amount.
Yes. I do have another program under conventional, right? That is called Home Ready and Home Possible. So those will allow you to do 3% down. There's also conventional that will allow you 3% as well, but the rates are a little bit higher. The mortgage insurance is going to be a little bit higher. The Home Ready is an excellent program. It's just that you have to do an income bracket. It's an income criteria, and we have to run the zip code, the property address, and everything to make sure that you're not at the maximum available income that threshold is for that area. So There is, the borrower has to do a home buyer seminar. They have to do it online. It's quick. It's like 15 minutes. You pay a little fee for it, but you do it online. And then so they get a certificate and that goes with the loan. But that allows them to go 3%. The mortgage insurance is much less too. So if a person has excellent credit or even 680 credit score, right? But their ratios are great, that's also a great program to put them under if they meet the income criteria for that loan.
So there's a question going back to the mortgage insurance, and it's
Mm-hmm.
asking that based on a $250,000 house,
Mm-hmm.
if you put down 20%,
Mm-hmm.
right,
Mm-hmm.
would you still have mortgage insurance?
If you're doing FHA, yes, you do. But if you're
But
doing conventional, you don't. Mm-hmm.
with the conventional, you won't. And if you're putting down 20%, most likely conventional is the way that you would go anyway.
Yeah. Yeah,
Yes.
all day long. I would shoot that. I mean, why would I want to
Yeah.
pay 200 and something dollars a month when I could get rid of it?
Okay,
Like
so
putting my
here are a
kids.
couple of other questions. What
Mm-hmm.
if you don't have any debt,
Mm-hmm.
but you have a score of 580? What if you don't have any debt with a 580 score, but is being denied for not having any credit? What are some options? So for this
Okay.
question,
Mm-hmm.
I don't know if you want to answer this because
Yeah,
this
I
is
can
more
answer it
building
for
up
her.
your credit.
Okay, I can answer, right. So at 580 with no, that means you have no trade lines, you have no credit cards, nothing, right? So you are like new. Because of that score, you will not be able to do a manual underwrite because that score is too low for a manual underwrite. So you have to build credit with that score. You can't do an alternate trade line on that score either because it's below the 620 where you can do a manual. So when you do an alternate trade line, so somebody never had credit cards, they don't have any bills at all, but they're at their score is, they have no score. We can build score for that person because you can get no alternate trade line. Say you pay your rent, you pay your light, your gas, or your insurance. Those are things that are called alternate trade lines, which we can now put and build a score for you. But you have no score, so that's like better than somebody who already have a score, but the score is under 620. When you're at 580, you're kind of limited without any credit cards. So what you want to do is you want to go start doing like what is called a secure credit card. That's the key. You need to start getting a secure credit card because the average person at 580 is not going to be able to apply to most of the credit cards and get a card. So you want to go to your bank and you're going to ask them, I want to open a secure credit card. It's going to be secured by your savings or your checking account or your relationship that you have with the bank. And that's the way that they will open that card for you.
So another question in here is, how about if I have excellent credit and
Mm-hmm.
no debt,
Mm-hmm.
makes 50 to 100,000 a year, but self-employed? And I think in South Florida, we come across that a lot.
Okay. So self-employed and you make $50,000, is that $50,000 gross or is that net? So
That
that's a
question,
big difference.
yeah. So they didn't clarify in there, but let's just say you give an example using that as, I'm going to probably say gross. Let's go off $50,000 gross.
Right. So if a business make $50,000, because that's the entity that makes the money, at the end of that Schedule C, we want to see the profit and loss that that business makes, and that's the income that we use over 24 months. So we don't use 1 year of the income unless you've had the business for 5 years, and we want to take it on a route where we do go less documentation. But if we're gonna do average for that business for nine in time like now, like 2019, 2020, we want to average that income. And it's going to be the net income, the net amount that you make after all your expenses. So $50,000, your expenses, and what you pay IRS as to say, this is my income that I make.
Okay. Last two questions. So someone it has a conventional mortgage. They've
Mm-hmm.
paid it down from 138,000 to $84,000.
Mm-hmm.
But their interest rate is 5.87%. Should they refinance?
Okay, how long have they had that loan? Because that's the factor. That's the key. How long
Uh,
have they had that loan?
I'm going to assume they probably have had it for, they
When
didn't
did they
answer
purchase, they
that.
said?
It was 138. Oh, since 2007.
2007. Okay, so you've already gone 13 years in mortgage. So because you've already gone 13 years and the balance is fairly low, you're not really going to reap a lot of benefits, because if I tie you into a 13, you're almost at 15 years now anyway. So I would just continue to pay where I'm at, because you're really not going to do a lot of savings.
Mm. So even that lower interest rate you're saying is not worth
It's
it.
not going to be, it's not, because it's going to incur costs. So at 88, they're going to add more cost to it. And then you're going to, for to make sense for her, to make sure that she's going to save, or him is going to save money, you have to put the term to like 15 or 10. I mean,
Okay.
that's the only way you would do it, is if they want to do a 10-year and credit is excellent and they could go in like 2.5 or 2.3, then that would make sense, because now it's going to be a 10-year. You're going to save money over time because you're cutting the term and you're also reducing the payment.
Okay. So two questions. Sorry. I love all the questions, guys. Okay. What's the minimum credit history length do you need before bankers will take you seriously to buy a home?
So credit history means that they have open trade lines, that they have credit cards going, that they have active accounts.
I'm
So
gonna say yes, but I think where this probably stems is when someone said they didn't have credit and you suggested they start establishing with a secured credit card.
okay,
How long do they need to show that
that the
history
history.
before?
Okay. So when you start using a secure card, you're going to need at least 6 months for it to really take effect on the credit bureaus. You won't see any much activity going on for 2 months, 3 months, about 6 months length of time,
Okay.
meaning you have to constantly be active with that card. You can't pick the card and then don't charge. There's no history. So you want to
So
charge enough each month that you can pay, so you can build a history over 6 months.
yeah. Okay, this last question. Can you get a loan while being unemployed, but you have a source of income with a credit score above 620 and basically low debt? They say debt below 60,000, but I think that's hard to answer when you don't know what the source of income is.
Okay. So source of income can be child support, alimony, social security, pension, disability. Those are source of income. So those, if somebody has an annuity and they're pulling money from it, so that's also a source of income. Because they have enough to last them for 3 years. The idea is to make sure that income is going to be able to last for 3 years. So if you have child support, that child has to be 14, because they need 3 years. So you need to continue that income for 3 years in order to use it.
And another way, and I know we've worked on some deals like this, is if they have so when we talked about the gift, right? Or if they have a family member who also is going to live at the home with them, right? So a lot of
Mhm.
times it's single people who maybe are currently still living with a parent who the parent is renting. If those two people got together and said, hey, we're already renting and living together, why don't we buy a home together?
Correct. Correct. Because you can team up and join and do a joint
Yeah.
together. Somebody just asked a question, Tiffany. I think the same lady was asking. Go back to the question that she just asked. I just saw it.
This is a different person. The
Oh, okay.
person saying income sources need to be proven for 3 years. Is that what I heard?
Okay, so we need 2 years income for any finance. But when you're doing like child support, you want to make sure that that income is continuation income for 3 years. So the income, so today's 2021, that income's got to continue from 3 years from now. So you got to have that income. So if it's a child support, the child's got to be 14. So if the child is 15 and we close when the child's birthday, say, okay, so the child turned 15, the child doesn't have 3 years because they don't have a mortgage yet. That child has to be 14 and not 15 before we close. If we close when the child's 15, we no longer have 3 years.
So that was our last question, Lisa.
Mm-hmm.
So one, I want to thank you for coming, but I want to just sum up because we've shared quite a bit of information. We've talked credit scores, debt to income ratio, amount of money you need to purchase a home, down payment and closing costs, high level ways that you could have that money help to reduce that total amount. And we've explained a little bit about FHA and conventional. What I really want to get out of this, because now we're approaching an hour and there is no way to get through all of this.
Mm-hmm.
The whole point of this is to give you high level information and really to say to you, the only way you're going to know if you're ready is if you go and talk to Lisa. That's really, you need to go and talk to
email me.
a loan
I'll be
officer.
happy to answer your questions.
Yes, because everyone's situation is different. And the first step, if you're nervous, right, is to go find out where you're at. So then you can make changes to where you're at to get to where you want to go. But if you're just nervous, like, oh, I don't have $20,000. Oh, my credit score is a 580. Then you're not even going to know where you need to improve. So Lisa, if the attendees as well as people who watch this would like to reach out to you, can you share your contact information?
Sure. My name again is Lisa Rochester. I can be reached on my cell phone, which is 954-665-8644. That is 954-665-8644. You can reach me on email at lrochester@prmg.net. That's lrochester@prmg.net.
And what I love about Lisa is that it's kind of just like with my business where it's family kind of owned, you're going to speak right to me. That's what I love about Lisa. You're not going through multiple people. She gave you her cell phone because when you call and you need an answer, you're speaking right to Lisa. You don't have multiple layers to go through, whereas where you bank at locally, you might have a lot of different layers to get through and a lot of different hands, where Lisa's going to hold from the start to the finish line. Lisa's going to be the one there. When we get to the closing table, Lisa's there. And when you first pick up the phone to call her, she's the one that you're speaking to. Lisa, I had one last question is, do you help outside of the state of Florida?
Yes, I can refer. I have partners that will do the outside of Florida. So we broker together. So we'll be fine.
And I am the same way. I am licensed in some states, but if I'm not, I can refer you. And Lisa, can you repeat your contact information one more time?
Sure. My cell phone is 954-665-8644. My email is Rochester, that's LROCHESTER at P like Peter, R like Rose, M like Mary, G like Garden.net.
And those of you who are attending through the webinar right now, after this, you are going to get a recording of this, and I'm going to also send out some documents, my contact information, as well as Lisa's contact information. So if you are looking for my contact, you can reach me on my website, www.josephrealtygroup.fl.com, and then as well as at my office, which is 954-652-1159. Sorry, you have so many numbers that you get confused. But then also on Facebook and Instagram. So definitely ways to find. So this will conclude our first topic. Next month, I am going to come back with another topic relating to the home buying process. And again, it'll be the same format where people can join the webinar, ask questions, and then it's being recorded so that for